Welcome to Griffonomics.
Thanks for having me back.
Yeah, glad to have you here because, well, imagine you hold two completely different businesses in your portfolio.
Okay.
On one side, you have the largest plumbing provider in North America.
Right. So we're talking toilets, pipes, all of that.
Exactly. And on the other side, you have the largest for-profit hospice care provider in the entire country.
It's just such a wild combination.
It really is. So today's deep dive is custom tailored for you, the learner, as we investigate this fascinating defensive odd couple that is Chemed Corporation.
Yeah, it's genuinely one of the most unusual corporate structures operating today, anywhere in the market.
Oh, no, definitely.
Through their Roto-Rooter segment, they reach about 90% of the U.S. population.
Which is huge.
Right. And then through their VITAS healthcare segment, they essentially operate this, well, I call it a hospice hegemony. They derive over 95% of that segment's revenue directly from Medicare.
Wow, 95%.
Yeah. So we literally have two wildly divergent operational models just living under one single picker symbol.
And our mission today is to unpack what management is calling Chemed's transition year.
Right, the transition year.
Because right now, the stock is currently trading at a 24% discount to its 10-year historical valuation.
Which is significant.
Very. So our goal today is to look at the financial realities, the hidden operational victories, and honestly, the looming political risks. We need to figure out if this discount is a value trap or if it's, a coiled spring.
Yeah, and to understand that 24% discount, you really have to look past, there was a recent pretty ugly earnings miss.
Right.
You have to look past that and understand the underlying hospice hegemony, because right now, Chemed is fighting a two-front war.
Okay, let's unpack this.
Yeah.
Let's start by defining the financial realities of this decentralized cash machine.
Good place to start.
So we break down the revenue split. VITAS Healthcare drives 64% of the revenue, and Roto-Rooter drives the remaining 36%. But the efficiency metrics are what really jump out.
Oh, they're staggering. If you look at the trailing 12-month return on invested capital, their ROIC, it sits at a massive 21.55%.
Wait, 21.55%.
Yeah, exactly. And to put that in perspective for you listening, the industry median is just 2.76%.
Oh, wow. That's just completely crushing the industry.
Absolutely crushing it. Now, it is slightly below their own 5-year median of 24.5%, but still, the cash generation is insane.
So they're generating all this cash, and yet there's this huge valuation gap.
Right. The stock is trading at a 22 to 23 times forward PE, which is roughly 24% below its 10-year average of 28.8 times.
But management isn't just sitting on their hands.
No, not at all. They are actively deploying that capital. They aggressively repurchased 932,500 shares for about $428 million in 2025.
That's a massive buyback.
Yeah, and they're also buying back independent Roto-Rooter franchises at 2.5 to 3 times revenue. They are buying the dip on their own company.
So they clearly believe in the model, but I keep thinking about this analogy, right? Owning a hospice and a plumber, it's like selling both umbrellas and sunscreen.
That's exactly what it's like.
Right. They're completely unrelated, but they're both non-discretionary, recession-proof services. If your pipe bursts, you call a plumber. If a loved one is terminal, you need hospice.
Exactly. You don't put those things off because the stock market is down.
Exactly. So if both are so incredibly resilient, why has the market punished the valuation by 24%?
Well, it comes down to uncertainty. Wall Street hates uncertainty,
Yeah.
And the discount is a direct reaction to some immediate operational headwinds in both segments.
Like what?
Well, on the hospice side, they dealing with this brutal government math. And on the plumbing side, they're fighting algorithms.
Algorithms for plumbing. Okay, we'll get to the plumbing later. Let's move to the primary driver of the business first, VITAS. I want to decode this government math you mentioned because it nearly cost them tens of millions of dollars in Florida.
Yeah, the Florida cap crisis.
Yeah.
So you have to understand the Medicare aggregate cap.
What exactly is that?
It's basically a statutory limit. In 2025, the government said, we will only pay you a maximum of $34,465.34 per admission.
Wait, so if one patient's care costs $50,000, they just lose money?
No, it's an aggregate cap.
Mm.
So you take your total number of patients, multiply that by the $34,000 limit, and that gives you your total allowable revenue pool.
Ah, okay. So some patients cost more, some cost less, and it averages out.
Exactly. As long as your average revenue per patient stays below that cap, you're fine. But if you exceed the limit, you have to write a refund check to the government. dollar for dollar.
Ouch. So what happened in 2025? Because they totally blew past this limit in Florida.
They did. And it actually traces back to the pandemic. VITAS deployed this community access strategy because staffing was so tight.
Right, everyone was short-staffed in healthcare.
Right, so they focused on admitting patients in nursing homes. The problem is, nursing home patients tend to be long-stay patients. They have conditions like dementia, where they decline very slowly.
So they're in hospice for a much longer time.
Exactly. And more days in hospice means Medicare is paying VITAS more total revenue for that patient.
Okay, I see where this is going.
Yeah. Because they had so many long-stay patients, their average revenue per patient skyrocketed way past that statutory cap.
And that triggered a massive $27.2 million cap liability in Florida.
Yep, they suddenly owed the government $27.2 million.
Yeah.
And the market freaked out. It temporarily erased over $1 billion from Chemed's market cap.
$1 billion wiped out over a $27 million bill. That is wild.
It is. But what's fascinating here is how management fixed it. They didn't rely on financial engineering or buybacks to solve this.
No.
No, they literally altered their clinical admission patterns on the fly. It was a brute force operational shift.
Right, so to wipe out this debt, our sources show they instructed their staff to aggressively target highly acute, short-stay patients.
Exactly.
They pushed hospital admissions to a post-pandemic high of 44.8%.
Because a patient coming from a hospital ICU into hospice usually has a very short life expectancy, often just a few days.
Okay, it's like a restaurant, right? Imagine a restaurant realizing they're losing money on these campers who just sit at tables all night drinking coffee.
Right, yeah.
So they suddenly start aggressively turning tables with fast eaters just to satisfy some daily quota.
That's a great analogy. By flooding their census with these short-stay hospital patients, they massively increase their total number of admissions.
Which raises their total aggregate cap limit.
Exactly. But because those patients didn't live long enough to generate much billing, the actual revenue barely moved. It mathematically diluted their average revenue per patient and completely wiped out the Florida cap liability.
Wow, they just hacked the math.
They really did.
But wait, turning tables that quickly in a hospital setting? That comes with a severe financial hangover, right? Because they had that 70-cent earnings miss.
Yeah, it was brutal on the margins. Short-stay hospital patients require really intensive, expensive care in their first 30 days.
Because you're setting up the hospital bed in the home, you're doing intense symptom management.
Exactly. All those upfront costs. Often, that care is delivered at a negative margin.
Wait, really? They actually lose money on them at first?
Yes. It takes time for a patient to become profitable. So by admitting thousands of people who passed away in just a few days, VITAS absorbed all the upfront costs without ever reaching the profitable phase of care.
So what does this all mean? Did management essentially borrow margin from late 2025 to pay off a government tax?
That is exactly what they did. The 70-cent miss looked terrible on paper, but it was actually the symptom of a highly successful defensive maneuver.
They took the hit to avoid writing a $27 million check.
Precisely. And now, for 2026, the transition is happening. The total company cap is expected to drop to a normalized $9.5 million.
Because the Florida crisis is solved.
Right. So now, management is instructing staff to normalize the acuity mix. They're pivoting back to those longer-stay, high-margin community patients.
But since it takes time for those new patients to become profitable, they're making what we call the back half bet.
Yes. Management expects 55% of their EBITDA to be generated in the second half of 2026.
Okay, so the foundation for the hospice recovery is set. But let's look at the other side of the odd couple.
Ah, yes. Roto-Rooter.
Right, because while VITAS's margin squeeze was, a self-inflicted strategic choice, Roto-Rooter's margin squeeze was forced on them by Silicon Valley algorithms.
It really was. The Roto-Rooter SEO crisis is a perfect example of digital risk.
Right, Google changed its search algorithm.
Yeah, and overnight, Roto-Rooter's visibility in those free local map results absolutely plummeted. I mean, they went from being visible in 72% of local searches down to just 24%.
That's a terrifying drop for a business that relies on emergency phone calls. If your basement is flooding, you just Google "plumber near me" and click the first thing you see.
Exactly. So to compensate for vanishing from the free maps, Roto-Rooter had to start buying paid search ads.
But they ran into a wall there, too. Private equity disruption.
Yep. They found themselves bidding against really aggressive private equity firms that are rolling up local plumbing brands. And these PE firms just drove the bid prices through the roof.
The sources said lead costs spiked to $94 per lead.
$94 just for a click that might not even turn into a job.
Yeah.
Total leads stayed flat year over year, but their marketing costs absolutely exploded.
And here's where it gets really interesting. It wasn't just Google hurting them. The high-margin water restoration business like cleaning up after a flood suffered an $11 million spike in write-offs.
Yeah, the AI insurance scrutiny. This is wild.
Yeah, explain this. Insurance companies are using AI bots now.
Right. So Roto-Rooter is decentralized. You have local branch managers typing up invoices for the insurance companies. But now, the insurers are using AI bots to scrutinize these invoices line by line.
Okay, looking for fraud or something.
Looking for any inconsistency. And because Roto-Rooter's branches all use slightly different billing terminology, the AI was just automatically rejecting the invoices.
Wow. So they were doing the work but just getting denied by a robot.
Exactly. It exposed their decentralized billing practices, leading to $11 million in write-offs.
So how are they fixing all these digital leaks?
Well, two big mitigations. First, they fired their old marketing agency and hired a new SEO firm.
And this firm is different. How?
Well, they target the underlying technical code of the websites rather than just buying ads. Plus, they actively shun private equity clients, so there's no conflict of interest.
Nice. And what about the AI insurance bots?
They are completely centralizing their water restoration billing.
Oh, the irony. Roto-Rooter is literally fighting AI bots by centralizing their own human billing teams.
Right.
It's like they found a massive leak, but the leak isn't in a pipe. It's in their own accounts receivable.
That's exactly what it is. And we have to highlight how crucial the commercial side of the business is here, too.
Right, because they're trying to bypass Google entirely with corporate clients.
Exactly. They're hiring dedicated commercial business managers to build direct dial relationships with, like restaurant chains and facility managers.
So the facility manager just calls Roto-Rooter directly, no Google search required.
Yes, and that strategy is already showing a 10% revenue bump in the participating branches.
Okay, so both VITAS and Roto-Rooter have these really granular internal blueprints for a second half 2026 recovery.
They do. The operations are sound.
But there is a massive external macroeconomic cloud hanging over Chemed.
Yeah, the 2026 midterm elections.
Now, just to be very clear to you listening, we are looking at these political scenarios purely through a financial and regulatory lens. We're taking absolutely no political sides here. We're merely reporting on the legislative mechanisms discussed in the source material and how they affect the stock.
Right, strictly just doing the math on the scenarios.
Exactly. So let's start with the blue wave scenario. This is a hypothetical Democratic sweep in the midterms.
Okay, so in a blue wave, there is a major risk that MedPAC-aligned policies could be enacted. MedPAC is the advisory commission for Medicare.
And what are they recommending?
Mathematically, it's pretty harsh for hospices. It would mean a 0% payment rate update for hospices.
0%, meaning they don't get their usual inflation adjustment.
Right. They usually get a 2.6% inflation baseline increase to deal with rising nurse salaries and stuff. That would be eliminated.
That's a direct hit to margins.
It gets worse. MedPAC is also floating a devastating 20% reduction in the aggregate Medicare payment cap.
Oh, wow. We just talked about how hard it was to beat the current cap.
Exactly. A 20% reduction would essentially create a strict permanent margin ceiling.
Plus, the sources mentioned increased auditing for high-margin services, like their continuous home care program.
Yeah, increased scrutiny there would drive up compliance costs even further.
So is the 24% discount on the stock less about Roto-Rooter's Google problems and more about Wall Street preemptively pricing in this blue wave margin ceiling?
If we connect this to the bigger picture, absolutely yes. The market is weighing the internal operational recovery against this massive external political risk.
What about the other side of the coin, the status quo or Republican scenario?
Well, a split or Republican-led government would likely maintain regulatory stability.
Gridlock is good for business, essentially.
Usually, yeah. It means a continued 2.6% annual inflation-based update, less aggressive auditing, and crucially, the absolute freedom for VITAS to execute that acuity mix recovery we talked about.
Right. If the PAP doesn't shrink, they can safely pivot back to those highly profitable, long-stay community patients.
Exactly. They can drive profitability straight back to their 2022 peak levels.
So if the status quo holds, Chemed is severely undervalued today.
But if the blue wave hits, the current discounted valuation might be perfectly accurate.
It's a fascinating standoff. To summarize all of this, Chemed is right in the middle of a deeply granular strategic transition.
Very much so.
They dodged a fatal Medicare cap bullet in Florida. They are plugging the digital and AI leaks over at Roto-Rooter. And really, everything hinges on this back half bet of 2026.
That's the proving ground.
But before we go, I want to leave you, the listener, with a final puzzle to mull over.
Oh, I love this part.
So the sources noted that private equity firms are treating plumbing leads as a loss leader.
Right, paying $94 a click.
Exactly. They pay these exorbitant amounts for search leads, maybe even lose money on the initial plumbing job, just to acquire a lifelong customer for their much higher margin HVAC businesses.
Selling air conditioners, furnaces, that kind of thing.
Right. But what if Roto-Rooter, with its massive free cash flow and unmatched national scale, what if they decided to flip the script?
Oh.
What if Roto-Rooter expanded into the HVAC space itself and beat private equity at their own game?
I mean, if the technician is already in the basement fixing a pipe,
Yeah.
the furnace is right there.
Exactly. It's right there. It could fundamentally change their growth trajectory.
That is a really provocative thought.
Something to think about. Risk defined. Portfolio protected.